Okay, has everybody typed in their chat box the city that you're in? Can you see them, Jessica?
I can. We've got a lot coming in: Toronto, Mexico, Atlanta, Philadelphia.
Thanks, and welcome everyone from around the world. Everybody around the world uses SAP, and controlling is part of SAP. So feel free to type questions in the chat at any time. Jessica will keep control and keep track of them all, and we'll answer them at the end of the slideshow. And this presentation is being recorded and will be published on ERPfixers website. So I'd like to thank ERPfixers for hosting this webinar. It's a lot of work to host a webcast. So thank you very much, ERPfixers, and Paul over Joe and Jessica. So if you're new to CO cost flows, if you type in questions, it helps you learn and remember. And if you're an advanced user or an expert, this helps others learn and remember. Why do I like SAP CO, SAP Controlling? Because every situation is different, new issues and new problems that every company deals with, and it's very interesting. Every situation is different. But if you know the basic cost flows, you can figure it out. That's the aim of this webcast, to help you understand the basics of cost flows. I will say that there's a lot of information about SAP Controlling. There's great books on material ledger. Paul Avagel has written a great book on material ledger. It's one of the best ones I've read. I've written a book on production variance analysis, but there's nothing out there that I've seen that ties everything together and to help you understand the cost flows. So that's what this the objective of this webcast is, to help you understand how the components work together in SAP Controlling. I encourage and welcome feedback on this webcast. If you've got any questions, you can send me an email at any time, ask me a question. Let's proceed. So let's start off. And okay, so everybody, I think, is aware of financial accounting, and the need for financial accounting is a legal requirement to meet external legal reporting requirements. It's got to be, you've got to be able to audit it. It's got to be precise and verifiable. Controlling, on the other hand, does not have to be so precise. It needs to meet the needs of internal management accounting to track the performance of the company itself. How profitable is the company? How profitable are the products that the company is making? That's one of the main goals of management accounting. It's flexible, it can be multidimensional, and it allows for estimates. Cost flows may not be an SAP terminology. It may be a term that I came up with to help others follow the flow of costs through controlling. So just be aware that that might be my term if you Google it. I generally do the cost flows on a whiteboard, because the whiteboards are bigger and you've got enough space to map out the whole process in controlling and see how the individual components move costs between themselves, and how they enter controlling and what happens to them after they're in controlling. This is fairly difficult to do in a PowerPoint. So this is the first time I've attempted to do that, to put it into a PowerPoint. So bear with me, and welcome your feedback. So let's see how this goes. When I start with a new client, I generally, one of the first things I do is have a whiteboard workshop. So we map up on the whiteboard the flows for that company, how they enter controlling, how they move through controlling, and where they move to in controlling. It's a great way for me to get a grasp of what the issues are at that client. And it's also a great way for the client to visualize what are actually happening to their costs in SAP Controlling. So I can't present this on a whiteboard, but I can present a photo of a whiteboard. So I thought that might be sort of a hybrid way of presenting the flow. So I thought I might just have a quick look at the photo of a whiteboard. This is from a few years ago, by the way. When I do the presentation on a whiteboard, I generally draw a horizontal line halfway across the whiteboard, and I make the top half financial accounting. And financial accounting is generally represented by T accounts, which are drawn there. And the bottom half of the screen, I make controlling. So there's FI at the top and CO at the bottom. And costs within controlling are represented by postings to and from cost objects. And I represent them by square, as you can see them on the whiteboard, hopefully. And at the very right-hand side of the screen, you can see there's a production order. So I wanted to point out on this slide to get started that you manufacture an assembly on a production order, and then you do a goods receipt into inventory. When you do that goods receipt, the production order gets a credit at standard for the standard cost times the quantity of the finished goods that you received into inventory. In this case, it's $900. And there's also, so there's a debit to finished goods inventory, and there's a credit to the production output account. And that also gives a credit to the production order. And then we get to compare the credits as standard with the actual cost. And then we have a variance at the bottom. So that's just an introduction to how this works. So let's move on then and talk in some detail of how this works. So by drawing a line halfway across the whiteboard, I'm saying that financial accounting and controlling are separate modules. There's several advantages to this. This is a European model, probably a German model. There's several advantages so that FI can be completely accurate and you can audit it. But in controlling, we've got a lot more flexibility with estimating and predicting costs. So SAP realized that early on that this introduces reconciliation problems between FI and CO. Because controlling, we move costs freely within controlling once they get into controlling without necessarily any tie back to financial accounting. So SAP introduced the reconciliation ledger in the early days, many years ago, to help with this. And it was some help. Didn't give all the answers, but it was helpful. FI reporting doesn't necessarily match cost center and production reporting. And that's many clients that question, why can't they reconcile between FI and CO? And so it's been an ongoing issue. You can produce custom reports to help with that, but SAP has come up with a much smoother way to do that. And they did that with the introduction of S/4HANA. And before S/4HANA and the column structure, SAP had to have many, many tables and aggregate tables and indexes because they couldn't have really large tables. So there was a lot of inefficiency within SAP. With S/4HANA, they can have really big tables, and that has allowed them to post all financial and controlling postings together in the one table, which, as you're probably aware, is called the Universal Ledger. At this point, I might ask everybody if you can put in the chat if you're using S/4HANA and the Universal Ledger, or if you're using ECC or even R3. If you could just put that in the text box for people to see. Let's see what we have. So hopefully, Jessica, you'll start to see those responses come through.
John, can you see the responses coming in?
Well, I can't. Can you give me an idea what sort of proportion we're looking at?
So let's see, we've got ECC, S/4HANA, ECC 6.7, 1809 HANA Live Support.
So there's a big variety. Okay, which is what I'd expect. There's quite a few firms have, or companies have, started using S4, but there's also a lot of firms deferring it for as long as they possibly can before they have to upgrade to S4 HANA. And different companies got different reasons for doing that. There's a large variety. That's completely understandable. So it means that in this presentation, I have to talk about ECC and R3 and S4 HANA, and that's okay. Let's try to see how that goes. So controlling is probably one of the modules that's most affected by S4 HANA, because now we're posting all our controlling postings in the one table with financial accounting, and that actually simplifies things greatly. It eliminates the need for reconciliation completely. Reporting is simpler. You only have to go to one table and pick out the fields that you want from one table. However, FI and CO are presently still separate modules. I know that SAP has been working on merging FI and CO for many years, mainly to do with S/4HANA and the Universal Ledger. So there'll always still be a need for management accounting and controlling those reporting to report on the efficiency of the company, but SAP is definitely working on merging the two modules. So as part of that merger, we've merged GL accounts and cost elements. So we'll talk more about cost elements in just a minute. But cost elements allow you to move costs into controlling from financial accounting. It also allows you to move costs within controlling separately. So now we've merged the two together. So basically, before cost elements were a completely separate entity within cost element, within controlling, and those cost elements are used to identify costs within controlling. But now, because they're merged with GL accounts, every posting from controlling and financial accounting goes into the Universal Journal if you're using S/4HANA, which makes reporting, it simplifies reporting much more. So with S/4HANA, profitability analysis becomes margin analysis. And I just wanted to make one thing clear here, that SAP prefers us to refer to profitability analysis in S/4HANA as margin analysis. And there's a reason. The reason for that is that SAP has based margin analysis on account-based COPA, which removes nearly all reconciliation issues that there were previously. Previously, costing-based COPA was best practice because it did things. It allowed us to report on production variances that we couldn't do in account-based COPA. But now SAP has introduced the functionality to analyze production variances and other variances in account-based COPA. And the account-based COPA, and by that I mean margin analysis, does its reporting out of the Universal Journal, which means that everything gets reconciled. With margin analysis, there's no timing issues. Everything posts to margin analysis as you post to the GL accounts in FI. It's still possible for cost of sales and revenue to cross periods, but there's other ways around that. That's a simple reconciliation issue. Reconciliation issues are vastly reduced. We still, in margin analysis, we still post the same profitability segments that we would have if we're using costing-based COPA, such as product, customer, and region. The cost flows within controlling are similar, which we're about to look at in detail. we still debit and credit cost objects. So let's look at the cost objects in CO now. I'm sorry, I'm still posting photos of myself, but I really want you to focus on the whiteboard in the background. We want to get back to the cost flow. So we're about to study the cost flows between financial accounting at the top and controlling at the bottom, the T accounts at the top, and the cost objects at the bottom. So in controlling, the concept has been that we're going to post all expenses from financial accounting to controlling. And we can do that by creating a primary cost element for every expense account in financial accounting. Now, previously, before S/4HANA, that was a completely separate entity. But now, of course, primary expense GL accounts have the primary cost element embedded in them. Is one way to describe it. So I thought we might start studying how costs get into controlling. So let's start with material costs, which is one of the main three cost components. So when we issue materials out of inventory to a production order, they go straight to the production order. So there's no need for a cost center. In other ERP systems, I believe that materials might go through cost centers, but in SAP, there is no need to go through a cost center because there's no allocation needed. We know exactly where the materials are going to. They're going to the production order on a production line. And we know exactly what the costs are because we just multiply the quantity by the standard price or maybe moving average price. So in this slide, I wanted to show that on the left-hand side on the slide, I put the financial accounts. On the right-hand side, I've got the cost objects. So on the left-hand side, we've got the balance sheet T account at the top, and we've got the P&L expense account at the bottom. So when we issue a raw material from inventory, we credit the raw material inventory balance sheet account, and we debit the raw material consumption account, which in this case, I've just made these numbers up. It's 400,000. So that's the GL account number. And in the case of primary cost elements, the primary cost element number is always the same as the GL account number. So as we move inventory to the production order, it's debited with the material cost against the primary cost element 4 and 5 zeros after it. So that's one of our main cost components is the material cost component. So there we've introduced costs into controlling from financial accounting, materials identified by the primary cost element. Now with the S/4HANA, that will post to the Universal Journal. So then we'll have a look at how activities and overhead costs debit the production order. How does that happen? And if you attended my last webinar, we talked about production order variance. So the variance comes from when we do the goods receipt from the production order at standard, we credit the production order the value of the finished goods, which is a standard price. So then the variance at the bottom of the production order is simply the actual cost minus the goods receipt at standard. So we analyze the variance by asking, why weren't the actual costs the same as the standard price that we estimated the cost should be? So then we can determine the success or not of our production efficiency. So materials are issued directly to production orders. It's very clear and fairly straightforward, although you can have things like scrap that can be a reason for variances. materials not issued to cost centers. No calculations or allocations are needed. And what I'm really saying is there that in overheads, you do need to allocate costs to calculate how much overhead to post to each production order. You generally value components at standard price or moving average. Finished goods are always valued at standard price based on vendor quotations for the components. The other thing here is you don't need, in SAP, you don't need to remember the GL account numbers when you issue materials to a production order. Anytime a material is moved, SAP references a configuration table where you set up which GL accounts are posted to during movement types. A movement type is a good to a production order or a goods received from a production order. You configure those GL accounts in transaction OBYC. My friend and colleague Ashish Sampat has written an excellent blog on how to configure the automatic account determination, and it's by far our most popular blog, and I really recommend you read that if you're interested in finding out more about automatic account determination. So I believe a goods issued to a production order is movement type 261, and you can do that with transaction MyGo, or there may be other transactions you can do with. And those configuration settings are stored in table T30. I thought I'd just record it in the slide, so when you reference the recorded session, you can look those up if you want to. And you can have a look at the entries in table T30 with SE16 as you can analyze any other table in SAP. Can I just do a quick question of everybody's attended this webinar? Who has read Ashish Sampat's blog on automatic account determination? Jessica, can you just give me an idea if anybody's responding?
So I have one yes so far.
Okay.
And one not yet.
Sure. I just recommend it. It's a good source for information on that. That's generally a lot of questions around that when you're configuring those transactions and the GL accounts when you're first setting up an SAP system. It's one of your main areas to set up. Okay. So I briefly discussed where the production order credit comes from. And if I asked the question, I hope that everybody would answer that the credit comes during goods received. So you've issued the component cost to the production order directly, and you've also debited the production order with activity costs and overheads, which we'll talk about in more detail in just a minute. And then we get a credit for what we've produced when we put it back into inventory. So we removed assets in the form of components. We put an asset back into inventory in the form of a finished good. And then of course, the variance at the bottom of production order is how we measure our production efficiency. And we discussed that in a lot more detail last webcast on production order variance. And if anybody's got any questions on that, please post them in chat, and we can discuss those questions at the end of the webcast. No problem at all. There's me again. This is a whiteboard flow. So you can see how much easier it is to follow the flow on a whiteboard because you can map out the whole process from GL accounts to cost objects, and then the flow between cost objects. For instance, cost centers, and then the flow back into inventory from the production order. So one of the questions that comes up then with the cost flow is, what do we do with the production variance at the bottom of production order? Those variances aren't accounted for as of yet. They're sitting on the bottom of the production order. So we need to take account, and the standard way to do that in SAP is to settle the variances to COPA. So COPA gets the posting when we do the goods receipt into inventory. So we know the cost to manufacture standard, but we need to add the variance on to the cost of manufacture standard in COPA to get the full true cost of manufacture. And then should we call it margin analysis? We subtract those full costs from the revenue that when we post the invoice. We ship the finished good to the customer during the day. And then at night, we have a billing due list that generates the invoice and sends the revenue to COPA. And now we've got the accurate profitability per product. A lot of companies know their profitability for the company as a whole, but it's quite difficult to get the accurate profitability per product. And that's a lot of what we're working on, studying these cost flows. So let's keep going. I want to spend just review variances. We've got input variances into the production order. We reviewed them in the last webcast, and you're quite welcome to ask me any questions on these. There's 4 input variances. Input price. If the price of the component changes between when you create the cost estimate to when you actually issue them to the production order, that will cause a variance. And the other variances have an explanation too. We have 4 output variances. So coming out of the production order, one of the main sources of output variance is the lot size variance. So if you're planning to manufacture in lots of 100 and you start manufacturing in lots of 10 because demand is decreased, that increases your cost per unit of production. And that is a variance. And you can analyze that in variance analysis. So now we've talked about material costs, and that's perhaps the easiest cost component. Let's have a look at overhead costs now. It's probably the most difficult cost to analyze. So the overhead costs are, you can define them as costs that you can't directly attribute to a production line or a production order or a production cost center. So we have to find a way of allocating those overhead costs across the production lines or across the production orders. So that's really the task at hand now. So this is where it gets tricky on this slide to put all these costs, but let's try. So again, we've got the FI GL accounts on the left and the cost object on the right-hand side. And instead of the production order being the cost object, now when we post overhead in FI, for instance, rent, if you've got several production lines, the rent cost of that building, you can't post directly to the production line. So you have to post to an overhead cost center, which are represented on the left, for $1,000. When we post the rent expense, it's got a primary cost element. So we have to have a cost object to post to. When we post that expense, we put in this overhead cost center as the cost receiver and controlling. And I believe that's the same in this for So the only difference would be down the bottom of that slide. We might not call it a primary cost element. We might call it the GL account, but the GL account has a cost element category, which has the same effect, I believe, as a primary cost element. So we end up with $1,000 rent actual debit to the cost object, which is an overhead cost center. And at this stage, you haven't got any credits to this overhead cost center. So down the bottom, the balance of that overhead cost center is $1,000. So now we have to figure out a way to get that $1,000 into the production order. So that's what we're talking about now. So let's have a look at that. We know that all FI expenses must post to a cost object, and that can either be a production order or a cost center. In this case, it's an overhead cost center, which we must now figure out a way how to allocate this $100 across the products that we manufacture at that on that production line within the building that we're paying the rent expense for. there's no credits yet on the SAP cost center. And by the way, the balance of a cost center is called the over-under absorption. It's the same idea as a variance. So now the next term might even ask a question on assessments at the end, but assessments is the primary mechanism for distributing costs from overhead cost centers to other overhead cost centers, and then end up in production cost centers. And you define a production cost center. That's the cost center that you confirm activities against for a work center. So I've got the same. So in this case, you'll notice there's no T accounts here. This is two cost objects. So this is how we move costs within controlling. We generally, on the left-hand side, you credit a cost object, and therefore you must be debiting another cost object. In this case, it's a production cost center. And in this case, it's not a primary cost element. In this case, it's a secondary cost element. Now, in S/4HANA, secondary cost elements have become GL accounts of a certain category that post to the Universal Journal. So it makes reporting much simpler. So there's a lot going on in the slide. So I suggest you you study this if you're not familiar with it after. You confirm, so you allocate all your overhead costs to production cost centers, which is on the left. And then when you have a production cost center, you calculate your activity rate that will give you a zero balance when you use your planned number of activities at a planned rate. In this case, if you look at the bottom of the production cost center, we're crediting the production cost center $300 when we confirm an activity on the production order, and we're debiting the production order the $300. So that's how we move costs within controlling between cost objects. Very similar process for overhead. At the bottom on the left, the overhead is $500. We've credited the production cost center. We've debited the production order. We're allocating costs gradually across all the products in this process. So on the right, on the production order, we're left with a variance of $100. Fair enough. We can analyze that variance and have a look at the variance categories and figure out what caused the variance. So on the right, that $100 has to be taken into account, otherwise it just sits on the production order and nobody knows it's there. So during month-end processing, we settle the production order variance to COPA. I'm sorry, material margin analysis. But also on the left-hand side, you can see we've got $20 sitting there that's unaccounted, perhaps. So we can assess the cost center balance to margin analysis and use a top-down distribution and margin analysis to spread those under absorption costs correctly amongst the products that are produced. So now we've got all our expenses distributed to all our products that we're reporting in margin analysis. There's a lot going on there. Now you don't have to assess the cost center balance to margin analysis, but it's good practice too, so you get all your costs into profitability analysis. And I think that's what I'm going to say in this slide. Oh, yeah, also margin analysis. You can settle the separate variance categories, the separate GL accounts in margin analysis. And that's one of the big step forwards with margin analysis. You couldn't do that previously to S/4HANA. That's why we use costing-based COPA. But now we've got visibility to a production order variance within margin analysis per GL account, which by the way, we post to the Universal Journal. So all expenses and revenues should end up in profitability segments in margin analysis, so we can get an accurate gauge of a profitability per project, per product. So the equation in margin analysis is simple. It's your revenue for each product minus the total cost. The total costs are the cost of goods at standard when you do the goods received from the production order into inventory. And you subtract those from the debits at actual to the production order. But you've also got to add on the production order variances, which we settle from the production order to margin analysis. And you've also got the cost center under over absorption that you need to assess to margin analysis to get all your costs into your profitability reporting. So all costs and revenue should end up in margin analysis. So another way to look at this is that profitability analysis is the end of the line of the cost flow. We'll get the costs into into controlling by creating expense accounts as primary cost elements, and then we allocate those costs through to end up against products in profitability analysis. Okay, that's an introduction, and I understand it's very rushed and there's a lot of detail, but it's an introduction to give you an idea. You don't read about this anywhere that I've seen, so please ask me any questions you like. After this, I'd like to just now talk about ERPcorp.com, which is my company. I'm offering a subscription-based learning service where I'll answer any SAP questions you have personally. We also have an SAP Controlling conference in San Diego in September 20th to the 23rd this year. Now, there's some very expert SAP speakers who will go into a lot more detail in some of the areas I just touched on briefly in this presentation. And it's a great way to network with experts and colleagues. So I encourage you to check out that conference. It's a great experience as well. There's some more details. If you go to ERPcorp.com, you'll find the conference and you can register there. It's coming up soon, so I would register soon. So let's open it up for questions. Jessica, can you share some of the questions that you've seen in comments?
Yes, let me just get the last one that popped in. And then we will go from there. We had several questions that popped up. Okay. The first question is, when do we use template allocation?
Okay, good question. Templates. So I've talked about assessments, moving from crediting an overhead cost center and debiting another overhead cost center, or debiting a production cost center. That's the simplest way to move costs. However, sometimes production isn't that simple, and you need calculations to figure out how much overhead to charge. It can be based on different drivers. So it's a more complex method of allocating overhead costs as an alternative to assessments or distribution. But there's more flexibility in template allocation, but it's definitely more complicated to set up. So it's a mix. I hope that answers the question.
So for those of you who are asking about the link for the automatic account determination blog, we will get that out to you guys.
Yeah. Sure.
The next question is, would you recommend using SAP variance categories or more user-friendly own variance categories?
Oh, wow. I would definitely use standard SAP. I didn't even know you could set up your own categories, but having said that, every company has their own specific requirements, but I don't think I've ever seen custom categories set up. I've always just been able to achieve what companies need with the standard categories. But hey, if you can figure that out, go for it.
The next question is there a way to have cost center variances reported in margin analysis without executing additional transaction of assessment?
That's a good question. And I would have to research that to see what functionalities in margin analysis. I'm not sure it's possible in costing-based COPA, but I will have to research that, and I'll find out for you.
And for those of you, as a reminder, in case you weren't in the webcast at the beginning, we will be posting the recording of this session as well as the answers to your questions and the questions that were provided on our website following next week. So next question is, talking about data flow in
Yes.
SAP S/4HANA, can we organize data to have standard costs reflected in transactional currencies?
I'll have to think about that for a minute. That's quite an involved question. I'm not sure. I would have to study that. It might be.
Is it possible to actualize the sales overhead cost absorbed in cost estimate via costing sheet like we do in T code CON2? Hopefully I said that right.
Can you ask that again, Jessica?
Sure. Is it possible to actualize the sales overhead cost absorbed in cost estimate via costing sheet like we do in T code CON2?
It sounds like you're asking a very specific question in S/4HANA, and I don't know the answer to that off the top of my head. It might be. It doesn't sound unreasonable, but I'll have to study that question as well.
How do you see the difference between production order versus process order VSPCC?
Product cost collector, I assume. So can you ask that again? Sorry.
Of course. How do you see the difference between production order versus process order? And then it says VSPCC.
Okay, so a process order is used in process industries, and a production order is used in white-based production. So there's not really much difference. If you use this, the nice thing about using standard variance categories, it should be very similar, if not exactly the same.
Does SAP provide any report on gross margin analysis using COPA characteristics with cost component split?
I would have to study that too, maybe.
What is the difference between SAP FI and CO?
Okay, that I can answer. So FI is financial accounting, and the easy way to remember financial accounting is it uses T accounts. Your traditional T accounts, and you always have two entries for reposting. In controlling, we have cost objects. So we get expenses to post from financial accounting into COPA by making the expense GL accounts primary cost elements in controlling. And then when we get all the expenses into controlling, we allocate the expenses through overhead cost centers, production cost centers, production orders, and into margin analysis. So that's basically the difference. I hope that answers your question.
How are all expenses posted from FI to CO?
Well, they're posted at the time that you post the expense in financial accounting. And when you post to that GL expense account, if it's a primary cost element in controlling, it must have a cost object or you will get an error. You won't be able to post the expense. So they post, the expenses post directly from the FI GL account, FI expense GL account to the cost object in controlling. And then the costs move between cost objects within controlling. Hope that answers the question.
Is there any standard report to show collective materials cost component? Something like a CKM3N collective. And if I am not pronouncing that right, I apologize.
No, I think you're right. I'm not sure what a collective material is, to tell you the truth, but I can have a look at that as well.
Next question is, do material expenses in production pass through cost centers?
Okay, material expenses do not pass through cost centers to get to production. You can issue materials to a cost center, absolutely. And there's more things like consumables, like cleaning products that you're not relating directly to a production order. But if you're talking about production, they go straight to production orders and not cost centers at all.
What movement type issues components to production orders?
Okay, I believe that's movement type 261 to issue components to a production order.
What SAP table stores automatic account determination in GL account?
That'd be table 30. And remember that you can review all these settings in table 30 with transaction in C16, which is very useful for when you're studying what GL accounts are going to be used through during automatic account determination.
What defines a production cost center?
Well, that's the production cost center is the one that you confirm activities. You credit the production cost center and you debit the production order when you confirm activities. Overhead cost centers, you credit with assessments and distributions, not activities. That's the main reason, the main difference.
And I believe this is the last question. If you have any more questions, we've got a few minutes. You can go ahead and throw that in the chat box. How do you allocate overhead costs from an overhead cost center to a production cost center?
Overhead costs from an overhead cost center to a production cost center, generally you would use assessments. There can be other ways of allocating costs, but generally the first thing you would look at would be assessments.
And a lot of you guys are asking about the name of the writer on the automatic account determination blog. His name is Ashish Sampat. And once again, we will go ahead when we post the recording session with the Q&A, we'll have that link in his name and his credentials there for you as well.
Great.
Okay, so we did get one question. I think we have enough time for this.
Okay.
For OH cost allocation from cost center to materials, is it industry standard to use a costing sheet or activity type as for direct labor activities?
I think the person asked, is it standard to allocate overhead with an activity type confirmation or with an assessment? Is that right? Yeah, no, a costing sheet.
He said yes.
Yeah. So costing sheet is easy to set up because the costing sheet does not involve production or manufacturing. The costing sheet you can set up yourself. You can set up activities to do exactly the same thing, but then you're involving production. Anytime you want to make a change, you've got to involve production. So costing sheets I would generally use if at all possible.
Great. We have about 5 minutes left, so I want to go ahead and wrap things up. I just wanted to thank everybody for joining us today. Thank you so much, John, for your presentation. We love having you on. And for those of you who have been to a few of our webcasts, we do have a couple more coming up, and you can visit our website as well as the ERP Corp website for more information on the upcoming conference in September. And one question did come in. I do have it recorded, so do not worry. We will get that out for you next week. All right, guys. Thank you so much, everybody. Have a wonderful Wednesday. Have a great weekend.
Thanks, Jessica. You too.